Okay, let's unpack this. Welcome to the deep dive. Today, we are cracking open the complex, winding, and almost two-century-long story of a financial giant that really started as just a local neighborhood bank, Citizens Financial Group, a name you probably know simply as Citizens Bank, and you provided us with a truly impressive stack of sources tracking CFG's transformation. We're not just talking about, a simple corporate history here.
Not at all.
We are looking at how global finance, regulatory crises, and just incredibly aggressive mergers and acquisitions can redefine what an American bank even is. We have material covering its massive period under foreign ownership by a European heavyweight, a surprising number of dramatic controversies, and its explosive recent push to become a genuine coast-to-coast competitor.
It's quite a story.
Our mission today is challenging. We're trying to distill this whole saga, nearly 2 centuries of history, billions of dollars in M&A activity, and some significant regulatory disputes into clear, actionable knowledge. And as we start, just remember, CFG is currently headquartered in Providence, Rhode Island, but it's now a major NYSE-traded S&P 500 component. This is a bank whose, I think, defining feature is its relentless ability to just redefine itself.
And that redefinition, as you'll see, has been profoundly effective. I think we need to establish the scale we're talking about now because it provides the essential context for everything that came before.
Okay, let's do it.
As of 2023, Citizens Financial Group reported a colossal $8.24 billion in revenue.
Wow.
And it held $222.21 billion in total assets. I mean, This massive financial engine requires a workforce of over 17,500 people just to keep running.
That's incredible scale. And what about their physical presence?
Well, it's no longer regional at all. It's national, and it's expanding fast. Citizens operates 1,078 branches and 4 wealth centers.
Okay.
And if you look at the map, those are spread across 14 states. From New England, Connecticut, Massachusetts, Rhode Island, down to the mid-Atlantic, so Delaware, Maryland, New Jersey, Pennsylvania, Virginia, D.C.
Right.
And then west into the Great Lakes region, Michigan, Ohio, New York, Vermont, New Hampshire. But crucially, they've recently added new growth markets like Florida and even Texas to that mix.
So they're really pushing out of their traditional footprint.
Exactly. And for you, the learner, looking at the U.S. financial landscape, the key metric is this. Citizens now ranks 18th on the list of largest banks in the United States as of the third quarter of 2024. 18th. So the story we're about to unpack is not one of slow, steady, organic growth. It is a textbook case of strategic, incredibly aggressive expansion and calculated corporate reinvention. And it was frequently operating under intense scrutiny and immense market pressure. Particularly during those years, it was owned by the Royal Bank of Scotland.
That's the part I find fascinating. That transition from a small local Rhode Island institution to the 18th largest bank in the country. That is the narrative arc of our deep dive. So let's trace it back to the very, very beginning.
1828.
1828. It was established as the High Street Bank right there in Providence. It spent decades just focused on local community needs. But the seeds of its future complexity, they were planted much, much later. In 1871, the Rhode Island legislature granted a second charter to establish the Citizens Savings Bank.
Right.
And that secondary entity, it eventually acquired its original parent, the High Street Bank, to form the Citizens Trust Company.
And what's fascinating here is that this wasn't all that unusual for the era, but it was crucial for their development. Think of it as the bank slowly buying up its own local ancestry, consolidating multiple smaller charters under one single banner. And that whole process culminated in 1954 when Citizens Financial Group was officially formed as a holding company. And that was immediately after it acquired the Greenville Trust Company.
So the holding company structure, that's the key.
It is essential to understand, yes, it allowed Citizens to separate its banking operations from its other non-banking investments, and that provided a scalable legal and financial framework necessary to pursue, future interstate expansion aggressively.
Without that, they would have been stuck.
Completely. They would have been restricted by the limitations of a state-chartered bank.
Exactly. And the final piece of the puzzle, the sort of internal transformation that really set the financial table for the seismic shift, that came in 1985. That's when Citizens changed its status from a mutual savings bank to a federal stock savings bank.
And that sounds like technical jargon.
It does, but the change is profound, isn't it?
It is. A mutual savings bank is owned and governed by its depositors. Its whole mission is safety and service, which often limits its ability to raise massive amounts of capital.
Right, it's conservative by design.
By design. By converting to a federal stock savings bank, Citizens essentially went public. It could now be governed by shareholders who were seeking profit. And that transformation, that unlocked these vast capital reservoirs that were necessary to fund aggressive mergers and acquisitions. It was a signal that the bank was actively looking for major outside investment.
And the very next year, 1986, they began expanding outside Rhode Island, starting with Massachusetts.
And that outside investment arrived with a vengeance. In 1988, the pivotal moment in CFG's history occurred. The Royal Bank of Scotland Group, RBS, acquired Citizens.
A huge European financial power.
A huge one. And they were planting a flag right in the lucrative U.S. retail market. So Citizens became a wholly owned subsidiary of RBS for 26 years, all the way until 2014.
So why Citizens? Why them?
That's the key question. RBS was looking for a stable, geographically strategic entry point into the massive U.S. Northeast market. Citizens, newly converted to a stock bank and perfectly positioned in New England, provided that clean, aggressive platform they needed.
So they were ready to be acquired, in a way.
They were primed for it. And the immediate result was a strategy of rapid acquisition, fueled by RBS's immense financial backing. Citizens just started snapping up smaller regional banks, allowing it to bypass decades of slow organic growth and become, almost overnight, the second largest bank in the entire New England region. That foreign backing was the catalyst for its current scale.
There was a brief, kind of interesting detour in that full RBS control, though. It suggests some complex financial maneuvering early on. In 1996, with the acquisition of First NH Bank, the Bank of Ireland suddenly gained a 23.5% stake in Citizens.
Right.
Was that required by the deal, or was RBS maybe a little nervous about carrying the full weight of the expansion?
It was likely a strategic necessity, probably related to the complexity of integrating First NH Bank, but also maybe a brief moment of co-investment. What's crucial, however, is that RBS almost immediately asserted its full dominance.
Okay.
The sources confirm that RBS resumed 100% ownership just 2 years later, by 1998. They bought out that 23.5% stake. And this move, it demonstrates RBS's firm commitment. They saw Citizens as a non-negotiable part of their long-term global strategy.
And once they reasserted that 100% control, they immediately doubled down on consolidation. In 1999, CFG significantly increased its footprint in Massachusetts, which was a core market. They did this by acquiring both the United States Trust Company of Boston and the retail banking business of State Street Corporation.
And these weren't just random acquisitions.
No, they were very strategic. State Street, for example, is a massive institutional player, so shedding its retail arm allowed Citizens to just pick up a ready-made customer base and a branch network in Boston, cementing their dominance in New England right before they planned their next big move.
And that set the stage for the true national push, what we call the strategic leap outside of the New England comfort zone, which began in 2001. RBS decided it was time to move Citizens from being a dominant regional player to a major mid-Atlantic force.
And the vehicle for this was the Mellon deal.
The Mellon deal. RBS purchased the retail banking division of Mellon Financial.Corporation, an institution with a huge presence across Pennsylvania, New Jersey, and Delaware for $2 billion.
Oh, billion.
Just think about the strategic implications of that. For $2 billion, Citizens instantly acquired hundreds of branches, thousands of customers, and deep market penetration across 3 new, highly populated states.
That single purchase instantly made Citizens Bank the second largest bank in Pennsylvania. It put them into direct competition with giants in 2 huge metropolitan hubs, Philadelphia and Pittsburgh. That pace of growth buying immediate market share rather than building it, that's the hallmark of the RBS era.
It is.
And their aggressive marketing statement followed immediately. That regional importance became cemented not by banking services, but by a major branding exercise. In July 2003, just 2 years after entering the state, the bank purchased the coveted naming rights for the new home of the Philadelphia Phillies.
That's right. Citizens Bank Park, which opened in April 2004. That move was a clear, tangible declaration of financial power. It said, "We are not just a New England interloper. We are a permanent fixture in the Philadelphia landscape." This level of investment and visibility, so quickly after entering a new state, it perfectly encapsulated the ambition that RBS had for this U.S. subsidiary.
Okay, so if the Mellon deal was a giant leap, the next acquisition, the Charter One deal, that was the moment CFG achieved escape velocity.
Absolutely. The Charter One acquisition in 2004 defined Citizens' shift from a massive regional bank to a genuine national player. In August 2004, Citizens Financial acquired the Cleveland-based Charter One Financial for a staggering $10.5 billion.
$10.5 billion.
To emphasize the scale, this single transaction was over 5 times the value of the Mellon deal just a few years earlier.
Wow.
And the geographic significance cannot be overstated. I mean, this was truly transformative. It added branches that stretched deep into the American Midwest, expanding their presence into Illinois, Ohio, Indiana, Michigan. Plus, it solidified their smaller existing footprint in upstate New York and Vermont.
So after that deal, what did that make them?
Post-acquisition, Citizens Financial instantly became the 12th largest bank in the United States. It was commanding over $131 billion in assets and operating 1,530 branches across 13 states. This was the definitive moment CFG transcended its New England identity.
But with that massive expansion came, well, immediate, complex, and frankly, somewhat comical logistical problems, particularly with the branding.
Yes.
You've just spent $10.5 billion, and you realize you can't even use your own name in the new territory.
It's the ultimate marketing nightmare.
This is where global ambition just collided head-on with localized banking tradition. The primary problem was that another entity, Citizens Republic Bancorp, based in Flint, Michigan, it had been operating since 1871.
A very old bank.
And it already operated under the Citizens Bank name across most of the acquired Midwestern territory. I mean, imagine the due diligence failure here.
It's astonishing. A bank that had too many names. Because of this conflict, CFG was forced to keep the Charter One name across its major new Midwestern footprint: Ohio, Michigan, Illinois, and Indiana. They were essentially operating a massive portion of their bank under a name they had just spent $10.5 billion to eliminate.
That is just corporate irony at its finest.
It really is. There was a slight exception, however, which just adds to the confusion.
Yeah.
The New York and Vermont Charter One branches were immediately rebranded as Citizens Bank. So you had this single organization with an internal branding barrier where crossing the Ohio state line meant changing the name on the door.
And the naming conflict wasn't just in the Midwest. They ran into another dispute even closer to home in Butler County, Pennsylvania.
Right.
In early 2005, just after the deal, a separate issue arose with a smaller but locally prominent Butler-based institution called Citizens National Bank.
So another citizen.
Another one. And this smaller bank forced CFG's hand. It led CFG to temporarily rebrand 7 of its branches in Butler County to Charter One, the very name they were trying to get rid of in the rest of Pennsylvania, just to avoid confusion and a potential lawsuit. It just highlights the immense difficulty of acquiring these old established banking charters. They often have deep historical name protections.
That localized dispute was resolved, thankfully, through a compromise. By mid-2005, Citizens National Bank agreed to change its name to Next Tier Bank.
Okay, so they blinked.
They did. And this concession then allowed the CFG branches in Butler County to revert back to the desired Citizens Bank banner. It's a great example of how large institutions sometimes have to pay a toll, either financially or, through corporate identity adjustments, to resolve these hyper-local conflicts.
But the big Midwest problem, Citizens Republic Bancorp, that persisted for years. It rendered a huge part of the $10.5 billion deal functionally incomplete from a branding standpoint. The final resolution didn't come until much, much later, between 2013 and 2015.
And it wasn't even something CFG did directly.
No. What finally cleared the way was another banking transaction entirely. In 2013, First Merit Bank acquired the competing Citizens Republic Bancorp and then subsequently rebranded all those branches.
So First Merit solved their problem for them.
They effectively wiped the name Citizens Bank off the map in that territory for the first time since 1871.
Only then, with the name finally available and the competitive conflict resolved, could CFG announce the rebranding of their Michigan and Ohio Charter One branches. And that name change officially took place on April 27, 2015.
So more than a decade after the acquisition.
More than a decade. It finally ended the Charter One identity in Cleveland, the city where that bank had originated. It's a classic case of an M&A ripple lasting 10 years.
And the story of Charter One doesn't just end with the rebranding. Despite the massive cost, Citizens later decided that certain parts of the network were, too inefficient or too difficult to integrate.
Or just too far from their core focus markets. This led to 2 major strategic sales, which shows that even giant acquisitions require some refinement later on.
Okay, so what were they?
First, in November 2008, they sold their entire network of 65 branches in Indiana to Old National Bank. This is a clear signal that they were exiting the competitive Indiana market to focus resources closer to the Mid-Atlantic. That transaction closed in June 2010.
Okay, so Indiana was first.
Second, in 2014, they sold 94 branches located in metropolitan Chicago to U.S. Bancorp. Chicago is a hyper-competitive banking market, and this divestiture allowed Citizens to streamline its Midwestern operations, perhaps conceding that the cost of running a massive operation in Illinois just wasn't yielding the desired return.
Yeah.
These sales really reinforce the idea that Citizens is constantly adjusting its network to maximize efficiency, even if it means unwinding parts of a multi-billion-dollar deal.
So let's move into the late 2000s. The biggest issue that affected not just Citizens, but the entire global financial system was, of course, the financial crisis of 2008. But for CFG, this crisis was compounded exponentially by its foreign ownership. It created this double layer of scrutiny, political pressure, and, well, financial catastrophe.
To put it mildly.
Right as the crisis was hitting, in May 2008, our sources indicate that Citizens Financial Group failed to publicly announce that it was under investigation by the SEC, the Securities and Exchange Commission, for its direct involvement in the subprime mortgage crisis.
And that omission is critical.
It's huge. The SEC was focusing on banks suspected of involvement in the purchase and sale of subprime securities, which indicates CFG was implicated in the very activities that drove the global crash.
But the real damage came through the parent company. The fallout for Royal Bank of Scotland for RBS was absolutely catastrophic. RBS posted the biggest financial loss in British corporate history.
The biggest ever.
And that resulted in RBS's effective nationalization by the UK government. The UK Treasury injected billions in taxpayer funds just to save it.
So suddenly, Citizens Financial Group, a major U.S. bank, was indirectly taxpayer-owned, but by UK taxpayers.
Exactly. And this dramatically altered CFG's risk profile and its political visibility. Domestically, CFG felt the pain directly. In 2008, the company itself lost $929 million and had to anticipate writing off $2 billion in bad loans.
Wow.
And following RBS's massive bailout, the parent company immediately announced deep cost-cutting measures at Citizens, reinforcing the fact that CFG's strategy and stability were now being dictated by the UK Treasury.
And the financial distress of RBS led to external legal challenges right here in the U.S. Specifically, allegations that RBS was using its U.S. subsidiary Citizens to prop up its failing European operations.
Right, it's a very serious accusation.
In 2010, a Philadelphia developer filed a staggering $8 billion lawsuit against Citizens Bank. The specific allegation was that the bank used what the developer called sham accusations of default to recall loans from customers.
So basically saying they were manufacturing defaults to get cash back.
Exactly. The lawsuit painted a picture of a desperate bank under foreign political pressure, potentially engaging in predatory practices simply to shore up capital. The sources confirm this huge case was ultimately settled out of court.
And the combination of the nationalization and all this legal turmoil, it fueled enormous public and political pressure back in the United Kingdom. The narrative was simple. UK taxpayers were footing the bill to save RBS, and public opinion demanded the RBS sell off profitable foreign assets like Citizens Bank to repay the Treasury. Citizens, ironically, had grown so large under RBS control that it became a political lightning rod in a foreign country.
And that created a genuine feeding frenzy among North American banks.
Yeah, oh, absolutely. Citizens was now seen as a forced seller, a massive, established U.S. retail network that was about to hit the auction block. Substantial interest was rumored from major Canadian players like Toronto Dominion Bank, TD.
Whose network would have fit perfectly.
And the Bank of Montreal. Major U.S. institutions like J.P. Morgan Chase, Wells Fargo, and regional powerhouses like PNC Financial Services were all mentioned as keenly interested potential buyers. Citizens was a prize, valued not just for its assets, but for its extensive deposit base and operational infrastructure across the entire Northeast.
So the decision finally came down not to an outright sale to a competitor, which would have consolidated the market even more, but to an initial public offering, the path to independence.
Survival as its own entity, yes.
In February 2013, RBS confirmed its plan for at least a partial spin-off of Citizens via an IPO. However, the UK political pressure to fully divest just accelerated the timeline dramatically. By November 2013, RBS announced that it would sell all of Citizens Financial Group.
No half measures.
None. This marked the official, irreversible beginning of the end of the RBS era, all necessitated by UK domestic politics and taxpayer demands.
And the transition back to public life moved quickly. The bank began trading on the New York Stock Exchange under the ticker symbol CFG, on September 24, 2014. And the IPO was a massive success. It raised $3 billion.
A critical moment.
It was. This is where CFG re-entered the public eye as an independent entity, no longer tethered to a nationalized European giant.
And RBS sold off its stake pretty quickly after that.
Systematically over the next year, their shareholding dropped to 45.6% by April 2015, and they fully completed the separation by selling the final stake in October 2015.
And yet they still use the logo.
That's what I find fascinating, the branding legacy. Despite this total separation and independence, Citizens still uses the former RBS Daisy Wheel logo. It's a silent, subtle nod to the massive expansion era, the foreign capital, that allowed it to reach its current scale. And this return to independence was immediately recognized as a major milestone. In June 2016, Citizens Financial Group officially joined the Fortune 500 for the first time.
Now that they were independent and a Fortune 500 company, they became subject to the full force of U.S. regulatory oversight. And that led to some tough revelations about internal practices that had been running during those years of foreign ownership and crisis. This is perhaps one of the most troubling stories we pulled from the source material because it really strikes at the fundamental integrity of banking. In August 2015, just months after the full divestiture, the Consumer Financial Protection Bureau, the CFPB, along with the FDIC and the controller of the currency, they levied nearly $35 million in penalties against Citizens Bank.
And the finding was chilling. The regulators determined that Citizens had engaged in systemic, deceptive practices between 2008 and 2013.
And the specific mechanism of this deception, it was just shocking in its simplicity.
It was. The bank failed to credit customers' accounts with the full amount of their deposits.
Can you explain how that worked exactly?
Let me be very specific. If a customer was depositing cash, and the actual amount of cash didn't precisely match the number written on the deposit slip, say, the slip said $300, but the teller counted $305, the bank failed to correct the discrepancy.
We just kept it.
Instead of crediting the customer the full amount, they pocketed the difference. Regulators calculated that this simple systemic failure to correct errors in the customer's favor shorted consumers millions of dollars over that 5-year period. It's a profound failure of basic institutional trust, and it happened during the crisis years.
The repercussions were significant and, I imagine, very publicly damaging.
Of course.
CFG was required to reimburse customers for all lost funds, which had to be a complex and time-consuming process, and was required to pay roughly $20 million in fines to the 3 separate agencies.
And the New York Times had a strong take on it.
They did. The New York Times editorial board, in its critical response, called the misconduct appalling precisely because it is so basic. Their argument was powerful. If a fundamental banking function like crediting a cash deposit could be systematically abused for profit, it demonstrated the absolute necessity of post-crisis regulators like the CFPB. For the newly independent CFG, this was a massive reputational burden to carry right out of the gate.
Then around the same period, Citizens Bank found itself inadvertently pulled into one of the biggest, most high-profile political investigations of the decade.
The probe into alleged Russian interference in the 2016 elections.
Yes, exactly. In May 2017, reports surfaced that the U.S. Department of Justice, the DOJ, had requested extensive transaction records for Paul Manafort, the former Trump 2016 campaign manager, from numerous banks, and Citizens was on that list. This request was directly tied to the investigation being conducted by special counsel Robert Mueller.
And the specific loan detail that brought Citizens into the headlines was that Manafort had reportedly secured a $2.7 million loan from Citizens in 2016. Now, lending money to a campaign manager is not inherently illegal.
No.
But the context of the investigation made this highly, highly sensitive.
And the subsequent market reaction reveals the depth of that sensitivity. In February 2018, when special counsel Robert Mueller's indictment of Manafort was released, Citizens' stock price dropped a significant 4.1%.
That's a big drop.
It is. And it suggests that the market perceived that Citizens was the institution referenced as Lender B in the indictment, which detailed a $3.4 million loan to Manafort. The concern for investors wasn't the size of the loan. It was the potential exposure to legal and reputational risks associated with the high-profile nature and the questionable collateral of the transaction cited in the indictment. Being a footnote in a massive federal political investigation is never a good look for investor confidence.
So if the earlier decades were about survival, consolidation under foreign pressure, and regulatory reckoning, the period from 2018 onward has been defined by, well, proactive, aggressive expansion designed to truly define Citizens' modern national footprint.
They're using their independence to shape their own destiny now. And we can trace this through three key modern acquisitions, each serving a distinct strategic purpose.
Okay.
First, in 2018, Citizens completed the acquisition of Franklin American Mortgage in a deal valued at $511 million.
And this wasn't just about mortgages.
Not at all. It was strategically crucial because it expanded Citizens' geographical presence into the newer, faster-growing Sunbelt markets of Tennessee and Texas. It was a clear move to diversify away from the slow-growth Northeast.
Then came two massive East Coast deals that were clearly designed to solidify coastal dominance and market share in high-value, lucrative markets.
Right.
In 2021, Citizens entered into an agreement to purchase HSBC Bank USA's entire retail operations on the East Coast. This was an incredible opportunity, acquiring about $9 billion in deposits and $2.2 billion in loans from a major international player that was looking to retreat.
A huge pickup.
The acquisition completed in April 2022, and Citizens took over 80 HSBC branches spread across major East Coast markets: New York City, New Jersey, Pennsylvania, D.C., Maryland, Virginia, and notably Florida. This move instantly propelled Citizens into direct competition with the largest national players in the Mid-Atlantic and Southeast coastal region using HSBC's established high-quality network.
And they did this simultaneously with another major deal. In July 2021, Citizens announced plans for its next big acquisition, New Jersey-based Investors Bancorp for $3.5 billion.
And this was about density.
Pure regional density. It was a significant push into the lucrative, deposit-rich New Jersey and New York metropolitan areas, taking over more than 150 branches that were highly concentrated in high-value demographics.
And that rebranding happened pretty fast?
Very. By February 2023, all Investors locations had been rebranded as Citizens Bank, further standardizing their network and eliminating another legacy name. When you combine the HSBC acquisition, which gave them the branches, and the Investors Bancorp acquisition, which gave them the market density, you see a clear, calculated strategy to become a dominant force along the entire Atlantic seaboard.
Beyond these massive mergers, Citizens has also adopted a pretty unique and highly flexible branch strategy. It focuses heavily on customer convenience, which often sets them apart from their more traditional competitors who are, frequently focused on closing branches entirely. The core of this strategy involves operating in-store footprints inside major supermarket chains. The greatest number of these are in the Pittsburgh-based Giant Eagle stores, a legacy acquired through that initial Mellon deal back in 2001. They also operate branches inside many Stop & Shop and Shaw stores throughout New England.
And this supermarket strategy offers a distinct competitive advantage, which you could call the Sunday advantage.
The Sunday advantage, I like that.
Historically, most major USA banks were closed on Sundays and often on Saturdays for full-service transactions. Citizens leveraged these in-store locations to offer full-service banking from 10 a.m. to 3 p.m. on Sundays. This convenience factor, it dramatically lowered the barrier to entry for customers and integrated banking into the customer's existing weekly shopping routine. Plus, you get high foot traffic and lower real estate costs than a standalone branch.
But even this seemingly successful strategy is dynamic. It's subject to market negotiation, right?
Yes, it is. For instance, in September 2010, Giant Eagle announced a new agreement with Huntington Bank, stating that Huntington would begin opening branches in several stores in Ohio and West Virginia, replacing existing bank branches, including Citizens, as those agreements expired. It shows that maintaining these unique, high-traffic relationships is a constant negotiation in the retail world.
And finally, we have to mention one of the more novel experiments that really illustrates their dedication to extreme accessibility.
The Dunkin' Donuts branch.
The Dunkin' Donuts branch. In October 2009, Citizens Bank opened a full-service branch inside a Dunkin' Donuts in Bellingham, Massachusetts. This wasn't just an ATM.
No, it was a real branch.
It was a functioning teller window, a full-service ATM, and they often ran promotions directly linking bank services to the purchase of coffee and donuts. It is an approach that truly prioritizes integrating banking into the most mundane and constant of the customer's daily retail routines. It pushes the boundaries of what a physical bank branch even needs to be.
So if we pull back and synthesize what we've covered, 2 centuries of history, relentless name changes, 26 years of foreign ownership, major regulatory conflicts, and continuous strategic acquisitions, it all culminates in the 18th largest bank in the U.S.
It's an incredible journey.
When we reflect on that journey, the importance of the Royal Bank of Scotland era cannot be overstated. Citizens' modern identity was absolutely forged during those 26 years of foreign ownership. RBS's financial backing allowed for the rapid acquisition-fueled growth, the Mellon deal, the massive Charter One deal, and dozens of others that expanded the footprint across 14 states.
Right.
It let them achieve a national scale that the original Rhode Island Mutual Savings Bank could never have reached on its own. It was foreign capital that provided the rocket fuel.
But that growth came with a cost.
A huge one. The transition to being the 18th largest bank also introduced, and sometimes created, massive regulatory and reputational challenges. Those are the hidden costs of that scale. This is clearly evidenced by the previously undisclosed SEC investigation into subprime securities, the devastating $35 million fine from federal regulators for systematically pocketing cash deposit discrepancies, a profound violation of trust, and the high-profile entanglement in the Paul Manafort investigation. Scaling up brings scrutiny from every corner.
And the most important current characteristic is that constant state of strategic flux. The modern CFG is defined by aggressive, opportunistic expansion like the massive recent acquisitions of HSBC's retail operations and Investors Bancorp to dominate the East Coast. But that's coupled with equally strategic, calculated branch management like the divestiture of the inefficient Chicago branches and the highly customized supermarket locations.
Exactly. They're constantly adjusting their physical and financial network to maximize the efficiency and network effect of their assets, always looking for the next growth opportunity.
So what does this all mean for you, the learner, watching the banking landscape? Citizens Financial Group, Inc., is a study in how global pressures and localized banking traditions collide, often with dramatic results. We saw the nationalization of RBS in the UK force the entire divestiture of this massive U.S. bank, and conversely, we saw the complex local history of names like Citizens Republic Bancorp and Citizens National Bank force a major $10.5 billion acquisition to operate under a temporary name like Charter One for years. It's a battle between the local charter and the global playbook.
A fascinating dynamic.
So the provocative question we leave you with is this. Given the sheer scale of CFG's recent acquisitions, pushing them into new, sprawling markets like Florida and Texas, their determined march shows no sign of slowing down. The question for the future is not simply how big Citizens Bank will get, but rather which historical corporate name, identity, or competitor bank footprint in one of those new markets will it eventually have to confront, negotiate with, or simply buy out next as its operational footprint continues its aggressive and nearly unstoppable expansion across the country. That's what we'll all be watching.